Hello, I'm Spencer Levy, Chairman of America's Research and Senior Economic Advisor at CBRE, and this is the Weekly Take, where we share our unique insights on what matters most in commercial real estate and the world at large. And this week, I'm delighted to be joined by my friend and colleague, Richard Barkham, CBRE's Global Chief Economist and America's Head of Research. Richard, macro. We've been on record suggesting that we are going to have a V-shaped recovery. We're optimistic as it relates to the macro, maybe not quite as optimistic with respect to the micro for real estate. Richard, how did we reach that conclusion?
Well, we took a look at each individual industry in the US economy, and we worked out what would happen under lockdown and what would happen when lockdown was withdrawn. And then we aggregated all of those views up and came with a view of GDP growth for the United States. And it looks like a very deep hit in Q2. But I think plenty of ability to bounce back in Q3, which I would call the recovery phase or the stabilization phase rather than the growth phase. And then really higher growth in Q4 and very strong growth in 2021. And it's based on pent-up demand, it's based on catch-up demand, and it's based on an extraordinary level of government stimulus.
Now, Richard, you suggested there a bottom-up approach going industry by industry, but I think it's fair to say we've also looked at it top-down, looking at other events historically, whether it be the GFC, 9/11, or even some comps in Asia. What do some of these comps tell us about the potential speed for recovery?
Well, we see in Asia, of course, we're following China very closely. And China had 2 months of lockdown, got on top of the virus very capably, despite a late start. And the economy, one quarter on, is bouncing back quite nicely. So China is our current comp. I also tend to think of big supply shocks to the economy, and I myself look at the oil shock in 1973, which I don't think most people will remember. But it brought Western economies to an absolute dead halt. But then a combination of government stimulus and monetary stimulus got the economy going quite quickly. The moral I draw from the 1970s, some people might look and say, surely you're not talking about inflation. And I'm not talking about inflation. What I saw after the oil shock is that growth resumed quite quickly. But the 70s were a period of volatility. And I do wonder, I do believe in the V-shaped recovery, the way the US economy can come back. But I wonder if the aftershocks of the COVID-19 are going to usher in a period of volatility. Not bad on average, but just a little bit more uncertain than we've been used to over the last 20 years.
Let's go micro here for a moment. Why don't you walk me through what your overall point of view is on the real estate recovery, and then we'll talk about the best and the most lagging asset types.
Yeah, so Spence, we see a V-shaped recovery for the economy, but we see a Nike swoosh-shaped recovery for the commercial real estate sectors, and a one-year recovery for the industrial sector, which has been remarkably resilient and has had a strong positive nudge from the growth of e-commerce. We see probably a 2-year recovery for offices, where there will have to be some new office protocols and new ways of managing offices established before leasing can continue. And then I think a 3-year recovery trajectory for retail, coming out of the fact that many of the food and beverage businesses and perhaps some retailers won't be coming back. They have to be restarted. New businesses have to come along to fill up that space. So 1, 2, 3, industrial, office, retail, but there's 1/4, which is multifamily, and I would stick that closer to industrial as a 1.5 year recovery, perhaps a bit quicker, as rents have dropped and as people come out of lockdown, they'll be seeking to form families and secure premises and get on with their lives. So that's how we would see it, Spence.
So let's talk about some of the sub-asset classes for a moment, because there have been some that have been hit really hard in the short term. And the question is, will there be lingering impacts?
I think clearly on seniors housing, that's a short-run reaction. Clearly on student housing, that's a short-run reaction that we would expect to come back along that Nike swoosh type of trajectory. But you've got to think, again, with the drift towards e-commerce and the use of Zoom, that this is a structural shift in favor of data centers and those kind of alternatives. So a bit of both, I think, there, Spence.
How might the slowdown of international air travel impact different segments of commercial real estate and impact certain markets?
I think there's quite a lot there. I mean, everything from student arrivals affecting university towns but I think the nearest and closest impact is going to be on the hotel sector. The hotel sector that is servicing international travel is clearly going to feel the pain. I think the more people who are not traveling internationally as likely, the more that spending is going to be diverted into the domestic economy. So I think we might see the hotel and leisure sector in around domestic vacation destinations doing quite well. And, we've been a little bit negative on retail. So I also think quite a lot of that money that is not been going on international travel, might get redeployed into the retail sector. We might see a stronger bounce in retail. And, I think it might, curiously enough, come back in auto sales. If people are not allowed the treats that they would normally have from international travel, they're going to be thinking about what new car I can buy. Any of the big cities that are associated with aircraft manufacture are obviously going to get a little bit of hit from this.
Both you and I know that we've gotten more questions from clients about, is this a permanent shift to what we call the fluid workplace, where people are going to be working from home, working from the back of a Starbucks, the back of a self-driving car. Now, over the next 12 to 18 months, there's clearly going to be a shift, but will that be a permanent shift? What do you think, Richard?
Well, I've been looking very hard at the CBRE data. We've got a very rich data set of office occupancy and vacancy, and we can look for the whole United States going back to 1985. And all I see is a continual trend upwards, and it's a very stable trend. We did hear it after 9/11, that people are never going to go back into tall buildings. And we're hearing it now. People are never going to go back into offices. I think it's way too early to come to that conclusion. Although you have to say that in the medium term, by which I mean that 18 to 24 months, the trend towards increased density that we were seeing, that is obviously going to come to a halt. But I don't think medium term this affects the overall demand for space, because that just comes straight out of the job market and the generation of service sector jobs, which we see continuing.
About 10 years ago, when I started talking to investors about the importance of sustainability in their projects, there wasn't a lot of interest in it. But today, it's in over almost 70-75% of office buildings. Do you think that wellness is going to become an equal partner to sustainability in commercial real estate going forward?
Clearly COVID-19 has given that a great big positive nudge, and it can affect everything. It can affect the HVAC systems that go into buildings. It can affect the furniture systems. We may need a shift to furniture systems that allow easier deep cleaning. It moves toward the nature and operation of the janitorial services within a building. So it could well, I think, push up the cost of running offices. That kind of until we learn about it and make efficiencies in it, the cost of running offices could go up. But increased focus on wellness.
I think we would both agree that industrial, which has been a net winner from e-commerce for the last 20 years, that's likely to continue. But is retail the net loser from this? Do they have a permanent negative impact?
I think the retail story, it's nuanced. Clearly, it's taken a big hit, and there's one of the area that's driven retail over the last 3 or 4 years is clearly food and beverage, and the social protocols around food and beverage are going to change, but they will come back. You can see it in Asia. You see it Asia post-SARS. Restaurants will come back.
Well, I think the retail death story has been written for 400 years, because retail is constantly evolving. So I actually am quite optimistic. Once we get past this 12 to 18 month period, you're going to see retail revert back to looking more like it was 2 months ago than something quite different, as restaurants are allowed to have full occupancy, as movie theaters are allowed to have full occupancy. And going to your point earlier about pent-up demand, I think the shortage of customers isn't going to be based upon lack of customer demand, but rather by state and federal rules about social distancing.
Yeah, I mean, you've got to say, the retail sector is one of the most entrepreneurial. And it's taken a hit, but you're likely to see new concepts and unpredictably new concepts coming through, and that provides the bounce back. Maybe take longer, but it'll be a reimagined and an interesting retail sector that reemerges, particularly with the spending that's been diverted from elsewhere in the economy.
So, Richard, let me ask you another question. What's going to happen with respect to the psychology of the average American consumer post-COVID-19? There are some people that are concerned that we are entering into a 1930s-style post-depression mentality, that spending is going to be depressed indefinitely. Do you agree with that?
After 1918, there was a huge pandemic of global flu. It killed, I think, 65 million people globally and maybe 650,000 people in the United States. And shortly after that, we had the Roaring '20s. So you had a period of consumer growth. You had a period of consumer exuberance. So I think these kind of harsh lockdowns can sometimes produce an opposite reaction, which is to more flamboyance, more consumption, more extravagance, as the fear factor and the lockdown factor disappears from the popular consciousness.
So, Richard, let me turn now to personal questions as we wrap this up. First of all, I know that you are a British citizen living here in the United States, and we're delighted to have you in Boston. But I know you've left your family behind, and some of them have suffered a bit through this COVID crisis. How's it going with you being here in the U.S., and how's your family doing back in the UK?
Well, very kind of you to ask, Spence. Both of my daughters, I think, had COVID-19, and my middle daughter had it quite nastily. And she's a very fit young woman who runs marathons, could hardly get up to take a cup out of the dishwasher without having to sit down and take a breather. Just makes me think that people should not take a risk with this. Mostly people get away with it, but it is a very nasty disease. But I'm keeping up with them as we are now, Spence, with all our clients by frequent Zoom and FaceTime.
Well, very good. So, Richard, on behalf of the Weekly Take, I want to thank you for being my friend, my colleague, and my partner. But it was a lot of fun having you as a guest, and I certainly hope that you and your family are safe and well, and we both root for this crisis to be over as soon as possible. Thank you very much, Richard.
An absolute pleasure, Spence.
For more information about what we spoke about today, as well as insights about how this week's latest developments are impacting the commercial real estate industry, go to cbre.com/The Weekly Take. Until next week, I'm Spencer Levy. Be smart, be safe, be well.